Hi, welcome to Westminster College Center for Financial Wellness. This class is an overview of the professional accounting environment. We'll talk about things like who makes all those accounting rules? Do all accountants follow the same rules? Are there governmental agencies that are involved in all this? These are some of the things that we'll cover. All right, so up front, the basic thing to understand is that the role of any type of accountant is really as a communicator of financial information. However, just like the fact that there are different types of doctors, like a pediatrician or a neurologist or a surgeon, there are different types of accountants. The financial business-related information that they provide or that they have knowledge over is specific to their area of expertise. So the basic types of accounting that we're going to talk about are tax, managerial, financial, and audit. So we're going to kind of differentiate these just a bit. Okay, so each of these different accountants basically would interpret the same scenario from their own area of knowledge. So for example, let's say there's a company considering some kind of purchase or merger or some kind of venture with a manufacturing business that helps supply some essential material that they use, all right? So we're gonna plan some kind of purchase or merger. So the tax accountant would help you determine the best business combination, a purchase, a merger, a joint venture, whatever, from a taxation point of view. Which method would result in the minimum tax assessment? A managerial accountant would provide information about whether the proposed arrangement will provide the required return on investment as compared to other company investments, or maybe they would consider the impact on overhead allocation, cost allocations, or maybe some pricing issues. So they would look at very internal to the company management type questions. The financial accountant would consider the proper way to record and report the resulting transaction, the purchase or the merger or whatever, to external entities. So external entities that are interested in this would be somebody like an investor, an analyst, a creditor. So these accountants present this financial information, the results of this, in financial statements. And of course, auditors would provide a level of assurance to all these external entities that the resulting purchase or merger and any continued transactions are properly reflected in those financial statements. Okay, each of these areas of accounting have their various private professional associations, governmental oversight agencies, as well as best practices and laws. But since this series, class series, focuses on financial statements, we're going to concentrate primarily on financial accounting. All right, the goal of financial accounting is to provide financial information to potential capital contributors. So that would, again, be investors or creditors, or even their advisors, analysts. So they're going to provide this information about the financial position and the results of operations of the company. And again, that's going to be through financial statements. Most resources in a market economy are privately owned. So that's like the US, we're a market economy, capitalist, what do I want to say? Free enterprise, that's a good way of saying it. So financial accountants are providing this financial information in the form of financial statements to literally everyone that has extra capital. And that's most people. Most people have a 401k. Some people have extra other money that they want to invest on their own. So the audience for the financial accountants is literally the public. Okay, in a free enterprise market economy like the US, financial accountants assist investors in making informed choices about what to invest in. So financial accountants on a large scale, if you think about it, help society as a whole allocate scarce resources. Okay, since the public, the owners of the resources, rely on information provided by financial statements to wisely invest their resources in companies that provide desired return, it follows that companies need to use the same rules. So information is consistent and comparable, and it allows investors to make those informed choices. So, who makes these accounting rules that dictate what is in financial statements and how the information underlying the financial statements is put together? In the United States, it is an entity called the Financial Accounting Standards Board, or FASB. So I'll give you a little history on how FASB came to be. So, like it says here, due to questionable and inconsistent and sometimes blatantly just wrong accounting methods that were used by companies in the early 1930s, the US Congress created a governmental agency called the Securities and Exchange Commission, the SEC, to oversee the accounting and reporting standards, among other duties. So the SEC then delegated the accounting and reporting standards creation to the accounting profession itself, since the SEC really didn't have the expertise to do this. All right, so here's Congress, the one in charge. They made the SEC, and the SEC is another governmental agency. The SEC gave the private sector the responsibility to make the rules. So through the years, from the 1930s to the present, we've had several different accounting standards bodies. CAP, can't remember what that even stands for, Committee on Accounting Procedures, and the APB, and currently we have FASB. So that's where FASB came from. But the SEC still has oversight responsibility. They can actually say, no, we don't like that rule, or change it, but they rarely do, but they can have input into accounting standards. Okay, one of the complaints about the early standard setters, the CAP and the APB, was that their rules that they did make were not consistent. Thus, the first thing that FASB did when they got together was create what they called the accounting concepts, financial accounting concepts, which is a framework from which they make decisions about how they make rules and standards. And again, all of this is to help us to try to be consistent in how we present information to financial statement readers so they can make wise investment decisions. So let's take a closer look at FASB for just a second. So it's the current standard making body over financial accounting. And as I said, it was created in about 1973, and it's the third committee that has been in charge of doing this. FASB is a private sector entity. It's important to know that it's not actually a governmental agency. It's made up of professionals. Some of the members, they vary over a wide range. There's just a lot of constituencies of people who are concerned about accounting standards. So some of the members might be in the audit area. They might be accounting educators, financial analysts, governmental accountants, so a lot of people involved. So the FASB creates the financial accounting rules, and in the US, we call it GAAP, Generally Accepted Accounting Principles, and publicly traded companies must follow GAAP. Okay, so the GAAP rules determine how the accounting information is accumulated and then presented in the financial statements. Okay, since companies all follow the same GAAP rules. The financial statements provided are more consistent and comparable. That's the whole purpose. All right, so what are the financial statements? We'll cover these quite a bit in upcoming lessons, but we'll just do a little bit of a preview here. The four main financial statements are the balance sheet, the income statement, the cash flow statement, and the statement of owner's equity. Companies publish these to provide investors insight into the company's results of operations and their financial position. Financial statements are presented in a consistent format, as I've said, among companies and by the same company year after year. All right, so the users of the financial statements, the potential investors, are actually expected to have a level of understanding of both financial statements themselves, as well as the rules that are followed to gather and accumulate and present the financial information. So in other words, there's just no way that we could provide all the information from of a company's financial situation, and we couldn't provide it in such a simplistic form that everybody could understand it. There's just too much. So FASB decided the level and type of information that is required in the financial statements. One additional thing about financial statements too, the actual financial statements take up about 5 or 6 pages of a report, of an annual report. Following the financial statements, there will be another 50 plus pages of what we call notes to the financial statements. The notes are integral to the financial statements. And what they are is actually a narrative and other detailed information supporting the financial statements. So there's so much information. Okay, so just a bit of a side tour. I thought I'd cover a few other accounting related agencies that you might have heard of so you understand kind of where they fit in. But for financial accounting, FASB is kind of the main body. Okay, you may have heard of the PCAOB, the Public Company Accounting Oversight Board. This is an organization that regulates audits of publicly traded companies in the US. It was created more recently, around 2002, by the Sarbanes-Oxley Act. You might have heard it called SOX. Thus, Congress created the SOX regulations, but the PCAOB, which was also created at the same time, oversees the enforcement of the rules. So auditors are going to be the ones who are subject to the rules and regulations overseen by the PCAOB. Okay, the IRS, Internal Revenue Service, everybody's favorite. Okay, it's part of the US Department of Treasury, and it's responsible for the determination, assessment, and collection of taxes in the United States. Again, Congress creates the tax code, the Internal Revenue Code, but the IRS is the one that utilizes those rules. So this is an entity that is of concern to tax accountants. All right, you may have heard of the IASB, the International Accounting Standards Board. It's kind of an equivalent to the US FASB. So this agency is endeavoring to create financial accounting and reporting standards that are common to all countries. So a lot of work was accomplished in early 2000s, I guess, by the IASB to converge various countries' accounting standards. It's a little less of a focus in more recent years, as most of their agenda has been accomplished, but their ultimate goal of one comprehensive global set of financial accounting reporting rules was not met. So as I said, the IASB is very similar to FASB, but it's on an international scale. But the International Accounting Standards Board has no enforcement capability or jurisdiction. Countries can choose to adopt the International Accounting Standards rules, called IFRS, or like the US, countries can keep their own GAAP rules and adopt portions of the international rules that make sense. All right, finally, the AICPA, you may have heard of them. The AICPA has standard setting responsibilities for accountants as a whole, for managerial, financial, tax, all of them, in such areas as professional ethics, business valuations, some aspects of financial auditing, financial statement auditing, attest services, CPA firm quality, things like that. So the AICP is integral to rulemaking in the CPA profession, the accounting profession, and it serves as an advocate for legislative bodies and public interest groups. All right. Right, so the remainder of our class, it will focus, as I said, on financial accounting and financial statements. This is the end of this portion of the class, so you're now ready to go ahead and take your related quiz.